Last year, McDonald's collected $10 billion in rent, not from customers, from its own franchisees. And that number, 10 billion, is almost double what the company made from royalties on Big Macs, fries, and every other item on the menu combined. Now, if you're thinking McDonald's is a burger company that happens to own some real estate, stop. Because the man who built the modern McDonald's, its first CFO, said it plainly in 1960s. We are not in the food business. We are in the real estate business. And here's the thing nobody tells you. The real size of this real estate empire isn't on their balance sheet. It's hidden. And once you see the actual number, you will never look at the golden arcs the same way again. Here's what most people believe about McDonald's. They believe it's the biggest fast food chain on earth. And they're right. Over 43,000 restaurants, more than 100 countries, system-wide sales of roughly $131 billion a year. Everyone knows the model. Big brand. Franchisees run the restaurants. Corporate takes a cut. Simple, but here's the catch. When McDonald's reports its own revenue to Wall Street, it's not 131 billion, it's 25.9 billion. That's less than a fifth of what the public thinks of as McDonald's sales. So where does that 25.9 billion actually come from? About 9.8 billion comes from company-owned restaurants, places where McDonald's actually sells you the food. The other 15.7 billion, roughly 61% of everything McDonald's takes in, comes from its franchisees. But here's where the plot twist starts. That 15.7 billion isn't mostly royalties on burgers. Royalties are only 5.6 billion. The much bigger chunk, over 10 billion, is rent. McDonald's is collecting rent on land and buildings it owns from the same people selling you your McChicken. So the question isn't whether McDonald's is a real estate company. The question is, how big is this real estate business? Because what's on the balance sheet and what it's actually worth are two different numbers. Let's start in 1957, because you can't understand the modern McDonald's without this guy, Ray Kroc, the man most people credit with building McDonald's, who was struggling. He was only collecting 1.4% royalty on the franchisee's sales. On a 15-cent hamburger, that is essentially nothing. Kroc was broke. Then Harry Sonneborn, his finance guy, had an idea. He said, Ray, stop thinking about burgers. Start buying the land restaurants sit on. Then lease that land back to your franchisees. You become their landlord, because a 1.4% cut of a hamburger, that's a coin flip business. But being the landlord for 43,000 highways, intersections, that's an empire. Fast forward almost 70 years. In 2024 alone, McDonald's collected $10.0 billion in rent from franchisees. To put that in perspective, 5 years earlier in 2020, that number was 6.85 billion. That's a 46% jump in 4 years. The rent collection side of McDonald's has been growing faster than the restaurant side, and that's not even the wildest part. Because while rent grew to 10 billion, royalties, the actual fast food licensing business, only grew to 5.6 billion. Read that again. The landlord part of McDonald's makes almost twice what the fast food part does every year, and accelerating. So where does the story get even better for McDonald's and weirder for the rest of us? Look at the profit margins. On every dollar of franchise revenue, rent and royalties, McDonald's keeps about 80 cents as operating profit. On every dollar of revenue from its own restaurants, where it actually has to pay cooks and buy beef, it keeps about 15. That's over a 5-to-1 difference. Being McDonald's landlord is roughly 5 times more profitable than being McDonald's. And that's why their overall margins don't look like restaurant companies. They don't even look like a food companies. McDonald's operating margin in 2024 was 45.2%. In 2025, it hit 46.1%. Starbucks, which people call the premium player in food service, 16%. The broader restaurant industry typically runs in single digits to low teens. 45% operating margins aren't restaurant margins. Those are software company margins, Microsoft margins. The reason McDonald's can hit them because half of what looked like a burger business is actually commercial real estate collecting rent in triple net leases. Quick plain English definition of triple net. The tenant pays the property taxes, the insurance, and the maintenance of the building. The landlord just collects the check. When you own 80% of the building across 43,000 restaurants on triple net terms, you are running possibly the cleanest real estate portfolio on earth. And we still haven't talked about what the real estate is actually worth. Here's where we close the loop. McDonald's balance sheet says, quietly in their 10K, that their property, plant and equipment is worth $25.3 billion net of depreciation. But that's the book value, the accounting value. Because of how GAAP works, McDonald's records land and buildings at the same price they paid for them, even if they bought that corner in Times Square in 1965, and that corner is now worth 400 times what they paid. In 2025, Macquarie Asset Management, one of the largest real estate investors in the world, ran the numbers. They estimated what McDonald's real estate would actually fetch at market value, about $120 billion. That's a $95 billion gap between what McDonald's balance sheet shows and what analysts think the property is actually worth. A hidden asset almost the size of Goldman Sachs. And here's the twist inside the twist. If you took just that real estate, just the land and buildings, spun off from the burger chain entirely, and listed it as a separate real estate investment trust, what would it be? It would be the largest REIT in the world, bigger than Prologis, which owns 1.2 billion square feet of industrial warehouses, bigger than Simon Property Group, which owns 245 million square feet of shopping malls. McDonald's hidden real estate business would eclipse them all, built quietly on highway intersection at a time, while everyone was watching the Big Mac. And remember, this is a company whose CFO told Ryan Kroc in 1957 what the business really was. Sonneborn said it literally. They wrote it down in the company history, and 67 years later, the numbers show he was more right than he knew. McDonald's is the single most successful disguise in corporate history, because while everyone was arguing about fry quality and Macquarie drops, the company was quietly assembling a $100 billion real estate portfolio, bought with the proceeds of a 15-cent hamburger. So the one-line version is this: McDonald's sells you a burger, but it's built on collecting rent, and that rent business, hidden inside the food business, is worth more than the food business ever will be. And looking ahead, this is going to get more extreme, not less. McDonald's plans to expand from 43,000 to over 50,000 restaurants by 2027. Every new location is another rent check, another plot of land that will compound in value for 50 years while someone else worries about keeping the milkshake machine running. So here's the question I want you to answer in the comments. If you were McDonald's board, would you spin off the real estate into its own REIT, unlock that $95 billion in hidden value, and let shareholders own the landlord and the restaurant separately? Or would you keep the disguise on, because the disguise is the whole reason this works? Team spit it off, or team keep the disguise? Tell me in the comments which side you're on and why. If you want more stories where the numbers tell a different story than the headlines, subscribe. New videos every Monday and Thursday.